Good morning, I'm Robert Tan, sitting in for Mikey Oreta, and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and insights you need to navigate, adapt, and lead. Let's dive right in. Growth hopes ride on government spending, yet it faces a slow surge, keeping growth under target through 2027. Construction should be booming, but it suffers a quiet collapse as building permits fall 22.6% in October. Investors stay wary as economic growth meets cautious pessimism, possibly slipping below 5% this year. Public spending rises just enough for a modest triumph, with disbursements up 1.2% and execution climbing. It's an ironic twist. The Philippines faces slow government spending and growth staying below target, possibly for years. GDP grew just 4% in the third quarter, the slowest pace in over 4 years, weighed down by weak consumer spending. Research from ANZ, or the Australia and New Zealand Banking Group, forecasts expansion of 4.8% this year and 5% in 2026, missing growth targets for a fifth consecutive year. The peso may weaken further, potentially hitting 60 to the dollar by March 2026. Economists warn that with stalled spending and sluggish growth, recovery could take longer than expected. Surprising news from the construction sector. Building activity in the Philippines is hitting the brakes. Approved building permits plunged 22.6% in October to 12,705 projects. This is according to the Philippine Statistics Authority. Total floor area and project value also fell, with approved projects worth 43.6 billion pesos, down from 54.45 billion pesos a year earlier. Residential permits, which account for more than 60% of total approvals, dropped sharply by 27.4%, led by declines in single homes and apartment buildings. Economists attribute the slowdown to high borrowing costs, tighter liquidity, and corruption-related uncertainty, forcing developers to delay projects. With construction activity slowing, the sector faces mounting pressure amid broader economic headwinds. It's a cautionary tale. The Philippine economy may struggle to break 5% growth this year as investor confidence wanes. The Employers Confederation of the Philippines, or ECOP, says investors are turning cautious amid corruption concerns and flood control controversies. This has led to fewer investment-related visits to the country. ECOP adds that growth could rebound in 2026 if the government restores trust, implements reforms, and rebuilds confidence to support job creation. For now, weak investor sentiment is putting the brakes on economic momentum, highlighting how governance challenges can ripple through the market. The government slightly raises fund disbursements to state agencies by 1.2%, signaling cautious budget expansion. Budget releases reached 4.57 trillion pesos as of end November, with a utilization rate of 94.5%. Of the total released funds, 4.32 trillion pesos is already spent, while about 250 billion pesos remain unused. Line departments received most of the funds, with the Department of Migrant Workers posting the highest utilization at 99.4%. Taken together, the numbers indicate steady budget execution, though a notable share of funds remains unutilized as the year closes. The numbers tell a troubling story. In 2025, the Philippine economy lost steam, growth fell well short of targets, households felt the squeeze, and confidence wobbled even as inflation finally cooled. So the big question now is this: was last year just a stumble or a warning? With 2026 forecasts still struggling to reach pre-pandemic growth, global pressures mounting, and governance issues clouding investment, what's really holding the economy back? And to help us cut through the noise and get straight answers, we're joined by Diwa Gunigundo, former Deputy Governor of the Bangko Sentral ng Pilipinas and Principal Advisor at Global Source Partners, on whether this slowdown is temporary, what risks matter most next year, and what Filipinos and business leaders should be watching now. Good morning, Diwa. Welcome to Business 360.
Hi, good morning, Robert, and thank you for this invitation.
Now, the Philippines slowed sharply in 2025 with quarter three growth around 4% to 5% below targets. Now, bluntly, what caused this structural weakness? Policy missteps or external shocks?
Well, indeed, the Philippine economy slowed down quite significantly in the third quarter at only 4%. And this is so much lower than the official target of 5.5 to 6.5%. The three-quarter average is only 5%. And therefore, it would take 7% for the last quarter of the year to hit the low end of the target. That is going to be a tall order, despite the holiday spending and the expected inflow of OFW remittances. I think it's both, no? First, the flood control scandal betrays a serious slippage in public policy. The budget process is stressed on public works projects which have traditionally funded corruption and bad governance. Instead of shoring up the budget for public education and public health, as well as socially critical infrastructure, the government and Congress tolerated congressional insertions and enabled them through the so-called unprogrammed allocations. This opened the floodgates for corruption and dampened economic and business activities. There was a chilling effect on public spending. Now, second, there are also global shocks that we also need to consider. The issue of the U.S. Tariff remains iffy and unpredictable. No one knows which direction the wind would blow, sending chilling effect on export sentiment and investment decision. No one would like to move and invest when faced with such uncertainty and volatile business climate.
Now, having said that, forecasts for 2026 still show growth struggling to hit pre-pandemic levels around mid 5%. Now, is this a temporary dip or evidence of deeper constraints?
Well, it looks like a temporary dip, but I think it is also showing evidence of deeper constraint through the sluggish growth in the third quarter shows the sluggish private consumption due to the adverse weather, especially with the onset of La Nina and a decline in capital expenditure. But I am afraid what we are seeing today is also more than a temporary dip. You are right, they are more of an evidence of deeper constraints. We have not effectively reversed the structural impact of the severe economic scarring we incurred during the pandemic. Infra development remains weak, and that means a declining potential capacity might not be reversed. Our human and capital development is also limited because our budget was spent more on infrastructure, okay, and on corruption and bad governance, rather than shore up the deteriorating quality of public health and public education. Innovation is more sporadic and an initiative of the private sector rather than a big policy or agenda of public policy.
Now, Diwa, we see inflation easing, staying within or below targets. Now, how much of BSP's policy is aimed at supporting growth versus guarding against future price shocks?
Well, we can see that based on the latest inflation forecast of the BSP, and that's 3.2% next year and 3% for 2027, there is indeed some scope for what the BSP did, and this is to go for another rate cut, okay? However, in going for another rate cut this month, it's quite clear the BSP's monetary policy is trying to maximize the use of space to bolster economic growth. But the root cause of economic weakness is not only structural, but it is also sentiment-driven. Very few would be so bold to remain bullish about, spending and investing. Very few would be so bold in coming here and investing here and putting up new businesses when you are dealing with a virtually dysfunctional bureaucracy. So sentiment-driven, it is something that the government needs to needs to address. And unfortunately, monetary policy is being trained to bolster economic growth. Economic growth could be limited precisely because the issue is not demand. The issue is the erosion of public trust.
Now, going outside, looking at external pressures like U.S. tariffs, global demand softening, and currency swings are cited as risks. Now, which poses the biggest threat in 2026?
Well, the uncertainty surrounding U.S. tariff is as much of a problem as global demand because they are interrelated. Despite the conclusion of some trade negotiation, for most regional economies, key details like implementation timelines and specific terms remain opaque. It is also possible to extend the tariff exemption to previously exempted items like semiconductors. Now, if all these unknowns materialize negatively, they could affect global demand. And a good counterweight is to strengthen intra-regional trade, but this could take time. So the real sector effect, Robert, could also spill over to the financial sector. With weak global demand, the search for yield could intensify and affecting in the process capital flows and currency movements. This could be potentially inflationary.
Now, looking back now internally here in the Philippines with governance issues, particularly around infrastructure spending, these have dampened investment sentiment. Now, how much does this affect the forecast, and what should government do to mitigate this?
Well, true. Government spending contributes less than private spending to the country's gross domestic product. It's only about 16%. But public spending is an influential signal to private investment and business, and at the same time has multiplier effects on construction. Thus, in the third quarter, the slowdown of 4% could be traced to weak government spending on top of a dip in household consumption due to the flood control scandal. The stricter validation of public works projects was undertaken precisely to avoid a recurrence of corruption and bad governance. As a result, we saw the sharp decline in public infra projects and slower government spending. So what was unhinged by the flood control scandal was public trust, business confidence, and interest. So the government should show two things, Robert. One, it should expedite the disposition of those corruption cases by being forthright with rooting out those involved from the lowest to the highest level of the bureaucracy. And two, it should assure the Filipino people that the Philippine Development Plan will be pursued wholeheartedly to shepherd the Philippine economy out of what we may call wilderness. A good blueprint, a good roadmap of how to translate the plan to more chewable bits could be very useful.
Now, being a consumer-driven economy and also relying on remittances by the OFWs to drive the economy, but with tighter U.S. immigration and remittance taxes looming, how do you think domestic demand will shape up in 2026?
Yes, it's important to consider household consumption, which accounts for about 70% of GDP, Robert. And cash remittances, on the other hand, from our OFWs alone at some 32 to 34 billion actually supports household consumption and to some extent investment as well. If because of the U.S. policy on tariff and trade, very strict immigration and their own tax cuts, the U.S. economy could go into lower growth trajectory. The demand for Philippine products and Filipino labor would also suffer some correction. And since the U.S. is both an important trading partner of the Philippines and an important source of overseas remittances, the domestic impact cannot be ignored. The effect cannot be trivial.
And
It could be significant.
And finally, for business leaders and Filipinos, should they be more optimistic or cautious or bracing for tougher times? Now, what's the single most reliable indicator should they watch?
Well, I think all of us should remain hopeful instead. Corruption and incompetence are given in any government or state. What we need to do is to ensure we don't get to elect the corrupt and the incompetent, comic characters, if you will. That's why we suggested to address, political dynasties which help perpetuate these political negatives. That's why we also suggested in our previous columns to overhaul our election laws and restructure the COMELEC itself. Hoping against hope, if Congress and the palace start cooperating to legislate these two important issues, that's the most reliable indicator. Growth, good inflation, fiscal numbers, the external payments position, these are the consequences of these two key initiatives of government. Most important, Robert, the flood control scandal and the broader issue of corruption actually galvanized the whole society into an important national movement, the trillion peso march. And that demands transparency and accountability in government. If this social movement further gains momentum, it could actually be a force for good government and a restoration of public trust in doing business in the Philippines. That could be a good start.
On that note, thank you very much for your insights, sir.
Thank you very much, Robert, for this invitation.
Thank you very much. Diwa Gunigundo, former BSP deputy governor, former governor of the BSP. Meanwhile, calls for an ethics complaint arise after later Representative Richard Gomez allegedly attacks Philippine Fencing Association President Rene Gacuma. Bicol South Representative Terry Ridon says hitting a senior or any person impinges on the reputation and dignity of the House. Gomez admits to his ungentlemanly action, but argues the PFA's decision to replace athlete Alexa Larrazabal is unjust and harmful to the team. The incident touches on accountability and governance, areas that often draw attention from investors and business observers. We're taking a quick break. Stay with us as we dive into the numbers and the stories that matter most to your bottom line. Wall Street rebounds overnight, showing that even after a volatile week, optimism can find its footing. U.S. stocks closed higher as gains in technology and AI linked mega caps offset sharp losses in consumer names like Nike. Micron hits a record high on strong forecasts, Nvidia rises on potential China chip shipment approvals, and Oracle jumps on a TikTok U.S.-controlled deal fueling AI optimism. European shares trade mostly flat as losses in tech and consumer stocks are balanced by gains in heavyweight banks. Investors now watch closely how overnight trends in the U.S. and Europe shape trading across Asia this morning. And let's check on how Asian markets are doing this morning. So far, the Nikkei 225, Hang Seng Kospi, Shanghai Composite, ASX 200, and the Straits Times Index are all in the green. Here at home, trading has opened, so let's look at the initial figures. The Philippine Stock Exchange Index is in the green, trading at 60.01. All of the sub-indices are in the green, with advancers currently outpacing decliners 95 to 47. So far, value turnover has reached 1.1 billion pesos. On the currency front, the peso opened at 58.70 against the dollar, unchanged from its previous close. Against expectations, the Marcos administration pushes forward its investment drive, even as it shuts down the very office meant to coordinate economic affairs. Local and foreign investors remain engaged, with coordination now handled by the Department of Finance and the new Office of Economic Affairs under the Executive Secretary. Finance Secretary Frederick Go stresses that investment promotion stays a top priority, citing its role in job creation, trade negotiations, and sustaining economic growth. He adds that key reforms, including the public-private partnership law, create more, mining regulations, and land leases measure, continue to anchor the administration's investment agenda. For now, the government signals continuity, assuring investors that reforms and engagement remain central to its economic strategy. The country's balance of payments, or BOP, sends a mixed signal as holiday dollars cushion but do not erase external pressures. The central bank reports the BOP deficit narrowed sharply to $225 million in November, down from over $2.2 billion a year earlier. Economists say stronger remittances offset higher holiday imports, debt payments, and portfolio outflows, stressing this does not mark a structural shift. Meanwhile, dollar reserves climbed to $111.3 billion, covering over 7 months of import and underscoring the country's strong external buffers despite a wider year-to-date deficit. For now, the data shows resilience, but the economy remains exposed to ongoing global and domestic pressures. Even as the Philippine Economic Zone Authority, or PEZA, sets its sight on 30 new eco-zones in 2026, the agency fell short of its target this year, a notable gap amid record investments. The Palawan Mega Economic Zone, a 28,000-hectare government-led industrial township, already attracts interest from foreign and local investors, spanning aqua farms to power companies. Since 2022, PEZA has opened 35 eco-zones, 11 in 2023 and 16 in 2024, but missed its 30 eco-zone goal for this year. Once operational, the new eco-zones are expected to bolster PEZA's investment performance, which hit a record 237 billion pesos across 307 projects in 2025. At present, PEZA balances ambition and delivery, aiming to expand rural investment while sustaining strong overall growth. It's a paradox. The Philippines scores just above the global average in sustainability, yet trails nearly all its regional neighbors. In the 2025 Global Sustainable Competitiveness Index, the country ranks 74th out of 192 nations. Scoring 47.89 out of 100, it remains the 6th least sustainable country in East and Southeast Asia. Key gaps persist in infrastructure, governance, and green finance, slowing the nation's climb. Experts point to weak policy frameworks and slow project execution as critical barriers. Without faster implementation and stronger governance, sustainable growth could remain a distant goal. Sometimes the calm after the storm comes years later. Vitarich is about to receive nearly double its Typhoon Ondoy insurance payout from AXA Philippines. The insurer initially appealed a 2023 court ruling but agreed to the larger 400 million peso settlement without admitting fault, avoiding a prolonged legal battle. Vitarich CEO Ricardo Sarmiento, authorized by the board, signed off on the deal effective December 19. The payout arrives at a crucial time, boosting net income by an estimated 196 million pesos and net cash flow by 267 million pesos, helping offset a 114 million peso loss in the third quarter after a record 2024 profit of 216 million pesos. For Vitarich, years after the storm, this settlement turns a long-running dispute into a financial lifeline. As we close out the year, it's easy to get caught up in the headlines, the challenges, the corruption probes, and the market volatility. But through it all, one question still matters most. What keeps us rooted in the Philippines, and what still makes the country worth believing in? This December on Business 360, we asked respected business leaders to share a short message answering what they love most about the Philippines. Today's feature comes from Stephen Tan, president of SM Supermalls, who leads one of Southeast Asia's biggest developers and the operator of 88 malls in the country and 8 malls in China. Here's Stephen's message.
Well, it's definitely our people. Despite the ever-changing times, we never lose sight of what truly matters. Our love for family, our respect for the elders, our sense of community, and these anchor everything we do. They're at the heart of why we do things. They don't shift with trends, they are constant. I also admire the Filipino spirit, not just our ability to rise above challenges, but how we do it right with ingenuity and grit and compassion. I witness this actually every day at SM, from the leadership of the C family to the incredible teams across our organization. I see it in every project we take on, a duty to serve with heart. It's this Filipino spirit that drives us to constantly move forward and push boundaries while staying grounded as who we are.
And that's it for Business 360. I'm Robert Tan. Thank you for joining us. Keep it here on BNC, the Bilyonaryo News Channel.